The stock market's like a wild ride. One minute you're up, next minute you're down, you're up, you're down again. But eventually, if you play all the right investments, you'll be on a private jet, sipping your champagne, looking into the distance into Malibu. Unfortunately, it's not that easy. See, despite all these random gurus and millionaires saying that if you buy my $200 course, I'll teach you everything you need to know to becoming the next millionaire, and it simply just doesn't work like that. Hi, my name is Austin. I have a 4-year degree in finance, and I'm going to be using my knowledge and expertise to help you and show you the top investments you can make in 2023 to make you rich. Unfortunately, I wish it was super simple, just buying that course and watching those videos, but it's just not that easy. But I am going to show you the tools that I have learned and what people use now to become rich in 2023. The investments that I'm going to show and the tools of the trade, I guess, go from the most simple and less risky all the way to the most risky investments you can make. I am no financial advisor, but these tools have been proven in the past to deliver results, and I'm going to share them with you. So first, I would like to talk about savings accounts and how they can benefit your investment strategies going forward. In the past 10 years, savings rate have been super low. And if you put your money in a savings account, you might make 0.1% interest, which is basically nothing. When I was younger, and I opened up my first savings account, I was super excited to see how much money I made, because in my head, I thought it was an investment. So if I put, $100 back then, I was like, oh, maybe I'll make $5 or $6. But no, you make pennies. So it's just crazy to think that people actually recommended that to us back then as an investment. But it is now kind of becoming an investment again. See here, I'll tell you why. And that's going to be due to higher interest rates. See, COVID has changed everything. Before COVID, interest rates were super low because inflation was super low. The Fed wanted to target 2% every single year, but during COVID, everything crashed and people were super scared and didn't know what was going on because it was kind of a new thing. We had never had a pandemic influence a market crash before. And the market went down super quick, but then V-shaped recovery and came right back out of it. And everything was kind of crazy because prices were going nuts. They were going up so fast. We had inflation around 9%. But the Federal Reserve told us that inflation was transitory, or meaning that they didn't think it was actually going to affect. But surprise, surprise, it really hurt us a lot. And we had the highest inflation rate since 1982 at 8.5%. So in order to combat inflation, the Federal Reserve had to raise interest rates, which made the inflation go down, but that brought on some new opportunities for investors. And a byproduct of these super high interest rates is actually high yield savings accounts, meaning that savings accounts can once again offer a higher rate of return compared to the 0.1 and 0.2 of the past that really made no sense to put your money in. And to kind of just explain this super simply, banks have the choice of keeping that interest rate money for themselves and making themselves money, or passing it on to their customers. That way their customers can get money. Meaning by just putting your money in savings accounts now, you can actually make a decent return on it with absolutely no risk. According to Bankrate's 2023 Annual Emergency Savings Report, they found that only 43% of Americans could easily make a $1,000 payment from savings. So I hope this kind of slowly incentivizes people start saving more, because Americans really need to start doing so, especially going into uncertain times. And a great benefit of savings accounts is it's super, super liquid, meaning that you put your money in there, and if you need it tomorrow, you take it out right away. You don't have to wait for your investment to settle in the stock market. You don't have to wait to sell real estate. You don't have to wait for the bonds to get cashed in. You get your money right away. So I'm going to be showing you 2 different accounts. One account is good for small accounts, and the other account is good for bigger accounts up to $1.5 million. And so maybe see where you're going to fall into these, and then, look into these tools for yourself. Both accounts have no minimum balances, no fees. So the first savings account to look at is SoFi. SoFi offers a 3.75% APY interest rate for their savings accounts, and in my opinion, this is going to be the best for the small savings accounts under $10,000. SoFi claims that you get 12 times the average savings account interest rates. There are no account fees, no monthly minimums, and no minimum balance to get started. You get access to over 55,000 ATMs, but also that comes at a cost because there are no physical locations for these. But at a time where everything's online, I don't think that's important as it used to be. You get overdraft protection up to $50, and by simply connecting your bank account to the SoFi savings account, you can earn up to $250 in bonus cash just for opening an account with them. I did find other places with a little bit higher yields, but they were very small banks that I had not heard of before. And I'd rather recommend something safer and bigger than, a little tiny bank that may or may not be any good. Next up, for larger accounts, I think over $10,000, it's perfect. The Robinhood Cash Sweep program. Yes, that trading platform that you've heard all about for the past couple of years, they now have a high yield savings account that, get this, is offering 4.15% interest. And they just updated that from 4% because the Fed has just increased interest rates again, and Robinhood wants to pass that up to their customers in order to get more customers into their system. Now, what's cool about Robinhood is the Cash Sweep program uses different banks in order to maximize FDI insurance. So normally, on a normal account, you get $250,000 of FDI insurance, but with Robinhood, you get up to $1.5 million of insurance, meaning it's backed by the government, so you can't lose it and it's no risk to you. They spread their insurance out between 6 different banks, meaning one bank gets $250,000, another one gets $250,000, the other gets $250,000, because Robinhood is ultimately a brokerage and they aren't a bank themselves. So by using 6 banks, they can get 6 times the normal FDI insurance rates that other banks would get. Now, it's important to know that these interest rates for both these accounts will not last forever, and they're tied to the federal fund rate. So right now it's super high, but in a couple of years or in a year, it might come back down. But for the time being during 2023, this is a pretty great deal considering 4% for money just sitting around doing nothing. But one reason I like Robinhood is because they're also a brokerage, meaning that later in the year or sooner, who knows what you think, when investment opportunities arise in the stock market, Robinhood, you can just send that money right away and you can quickly swipe and buy a stock right there without transferring any money. So I like it because it's ready to go. Some downsides with Robinhood, there's also no physical locations and it is a $5 a month fee. And that's why I'm recommending it for people with more than $10,000 in their account, because it does cost a little bit. And if you have less than $10,000, SoFi will make more sense to you. So like Robinhood is great Robinhood has great high interest savings accounts, but they also offer value to the stock market and allowing you to buy what I think is the number 2 least risky but best investments for 2023, ETFs, or exchange traded funds. See, ETFs are one of the fastest growing and best investment products you can make, with almost $6 trillion in assets in 2020. And my favorite benefits of ETFs is their low-cost management structures. So most people have heard of mutual funds, but not as many people have heard of ETFs. And a mutual fund is usually an actively managed fund. But with these actively managed funds, it comes with really high fees because they're paying people all the time. You have to pay fees when you put it in or take it out, but ETFs are not like that at all. There's only an annual fee. So a typical mutual fund will have an expense of about 0.5% to 1.5% of the whole portfolio balance every single year, while an ETF like VOO of Vanguard, which has the top 500 companies in the US stock market, has an average expense of 0.03% a year. Bringing us to the next benefit of liquidity. See, if you own a piece of real estate and the real estate market crashes, you most likely don't have time to get out of that. But if you own the real estate ETF and the real estate market is crashing, you can get out of that right away, because the real estate market is traded like stocks on the exchanges, meaning there are hundreds of thousands of people sharing and trading these ETFs all the time. Just log into your broker like Robinhood, Charles Schwab, Webull, all the above you can think of, and you just buy and sell ETFs just like stocks, because they are just like stocks. They're exchange traded funds. And what's another big benefit is they minimize the tax burden on the user. So some ETFs are kind of actively managed, meaning they're buying and selling different stocks for the portfolio. But if you're just holding that ETF once and you don't sell it over that year, but the portfolio has made a bunch of different changes, you don't pay any taxes. All of that's done on the other end of things. But if you were to buy all those stocks yourselves and sell them all yourselves, you would have to pay tax each time they're bought and sold. So if you just hold the ETF while all the other work is done by the company, you don't actually have to pay any different taxes on it. You just have to pay the long-term capital gains tax if you hold it for more than 1 year. And that brings me to transparency. When you're holding the ETF, you have the ability to log into the ETF's website, and they will have a different sheet showing all their different holdings, how much they're holding, and how much of the portfolio it makes up, so you can know exactly what you're invested in at all times. A 2019 study by JP Morgan Asset Management found that investors who held a diversified portfolio of stocks, bonds, and cash outperformed those who invested in just stocks alone by 2.5% per year on the average over the past 20 years. And that's what makes ETFs so good, is you can invest in all those different markets, not just stocks, but if you also want to use stock market, you can invest in stuff like the S&P 500, the Russell, all these big major indexes that would naturally be hard to do without buying the specific funds. So what are my favorite ETFs for 23, or what are my favorite ETFs in general for investments? And the two that I'm going to give you are VOO and VTI. VOO is an ETF made by Vanguard. It has extremely low cost and expense ratios, and it tracks the S&P 500, which are the top 500 companies in America. And the top 500 list can always change, but what's nice about the ETF is we'll always track what's in that top 500. So let's say there's, I don't know, a random XYZ company and they get pulled out one day and replaced with X company. Your ETF will track that and you will still have exposure to that without doing any of the work. And the other one is VTI. VTI has great expense ratios and it tracks the whole stock market. The S&P 500 one just tracks 500 companies, while VTI tracks the entire market, giving you exposure to every single sector, which is great for the portfolio. But in 2023, in order to make more money, you might have to take more risk. So the next more risky investment in 2023 is real estate. Real estate has traditionally been a great investment because it averages around 4% every single year and is one of the most stable and consistent returns out of all the different investments you can make. In 1950, home prices were between $10,000 and $20,000. And now the median home price is nearly $467,000. And that's an average return of between 5 to 10% every single year. And you've probably heard the saying that owning your own home is the best way to build wealth. And that's totally true. Not only does your home increase in value over time, but you're not paying your normal living expenses, meaning you're not paying rent and you're putting all that money into your house, which is almost like making it a high yield savings account, but you get to live for free because your home's increasing in value and you don't have to pay for rent anymore. But Austin, aren't houses too expensive right now? And it's possible, but Goldman Sachs thinks in 2023 will be set for a great time to buy a house. And I think that there's two factors that will cause that. One, that housing prices will lower over the course of 2023, making the house just cheaper in general. And I think the second factor is that interest rates will lower from where they are now, around 7% to around 5.7%, making the mortgage also cheaper to buy. So if you have lower prices and a cheaper mortgage, that's going to be the best time to buy a house or real estate, and they're predicting that's at the end of 2023. And if you want all the predictions of the housing market and what it will do, I went over all of them from the top firms in the country in my last video, so check that out. So like I said, interest rates are kind of high right now, and the 30-year fixed mortgage rate is 6.9%. But even comparing it to the early 2000s rates, that isn't too terribly bad, as in the early 2000s we were in the same territory. But we want to ultimately get back to those late 2010 levels where we're in the 2 to 3 to 4% range. And Trading Economics ran some models that's pretty cool and pretty interesting, saying that interest rates could be as low as 3.25% by 2025. So what is really cool is maybe it's a good time to buy a house right now. You buy the house, it starts appreciating in value, and then in 3 and 4 years, you refinance your house and get that cheaper mortgage rate. That way your normal monthly payments are lower, while also owning a house for 3 or 4 years and not paying any rent at all. And this is how people become wealthy, is they buy a house when the younger the better, but if you're not young, that's okay. And by the time their mortgage is up and they have paid $250,000 into their house, and maybe their house is worth $400,000 now, meaning that your house went up by $150,000, but you also have the house completely paid for. So if you went to sell it, now you could make $400,000 just from owning a home. In my opinion, the cost to not own a home is way higher. Then owning real estate is also great for diversification. You don't want to have all of your eggs in one basket, and real estate will allow you to do that. So if you have a bunch of money in the stock market, it's also good to own different commodities or real estate, maybe gold and other precious metals. But for 2023, I think the best deal is real estate. And not only do you have to live into it, but you could also choose to rent it out and make money on top of your investment. Big companies like this Goldman Sachs-backed rental fund bought an entire community of 87 single-family homes in Central Florida. And ultimately, investors have the goal of making their property cash flow. Let's say your overall expenses for your property are around $1,500. Well, if you can rent that out for $2,000, that means you're making $500 a month, and your tenant is paying for your mortgage and you're getting a house for free while also making money on top of that, while also the real estate is appreciating in value too. Essentially making you rich. So, I mean, I don't know what else to say about that. But if we're talking about rich, we might as well be talking about the most risky investment you can make in 2023 to see huge returns. And I think it's growth stocks. See, growth stocks are just any stock that is predicted to outperform the market, or I guess not predicted, but will outperform the market. And these companies reinvest their earnings back into the company, making them grow faster and faster and faster. Tesla and Amazon are considered a growth stock. As these companies grew, they went parabolic and the stocks went nuts. At one point, from right now, Tesla is up 15,000% from its IPO. And at the all-time highs, it was around 33,000% higher than its IPO. And yes, this is crazy, crazy growth, but they're overall going way faster than the rest of the market. So benefits to growth stocks is they provide a huge potential, meaning a lot of people don't see value in them now, and you want to be one of the first ones in before they start going nuts. Let's think of Tesla. They had a new idea that kind of disrupted the market, and they implemented it in a very efficient way with their electric car manufacturing. But since these companies haven't been around very long, they bring on a lot more risk. And the reason they bring on a lot more risk is because they have they have high margins, but they're kind of smaller because they reinvest everything they make, their marketing, R&D costs, and whatnot. So they have razor thin lines of if they don't reinvest it, they won't grow. If the income drops unexpectedly, then they're going to be operating at a loss and could look at things like bankruptcy. And Tesla saw bankruptcy a number of times during its period. So what do you look for in a growth stock? And you want to look at industries that are growing and have a lot of potential moving forward, like tech companies, chip companies, software companies, maybe even energy companies. You want to see strong sales growth, meaning sales are growing every single quarter. And you want to avoid any overvalued or overhyped stocks. This can easily happen with growth stocks. So let's say you're at Thanksgiving and you start hearing grandma talking about XYZ company. XYZ company is probably overvalued and heading down. So my pick are going to be sectors. I don't want to talk about specific stocks, but sectors I think could do really well are tech and maybe any companies that have something to do with AI. I think it looks like AI is kind of taking over right now. So if you can find companies that really use AI or will bring AI to the table, I think that could be a good pick. As well as the energy sector, specifically solar. I think in the next 5 to 10 years, solar companies are going to do really well. And the last thing I want to talk about is investing your time. See, your time is super valuable and super important. And I think this is one of the greatest investments you can make in yourself and your financial future. Self-improvement, like taking courses on things you don't know a lot, or subscribing and watching more videos about things that you may be interested in. Reading and listening to books is a great way to invest your time. Rich Dad, Poor Dad is one of my favorites and talks about the different perspectives of investing and avoiding different incomes and assets. And it's a great book, and I think you should give it a chance. And then the last thing I think you should invest your time is your fitness and your health. Overall, being healthy reduces stress and helps you make better financial decisions. And if you can be healthy and you can feel good about yourself, you can live longer too. And it helps you be able to put in more work. I just wanted to briefly cover that. I hope this video was interesting. It helped you learn a little bit about the best investments for 2023 in order to make some good money. These are what the pros do but for me, if you're interested in my topic, please subscribe to my channel. And if you'd like, please watch another video as I'm trying to make new content every single day. And I will catch you on the next one.